We should just do murder mysteries. Austyn, we should do murder mysteries. We should do a murder mystery themed life insurance podcast to try and scrape up some of that market.
We could do that. I mean, just think about, I don't think 60 Minutes would be around if people just got appropriate insurance recommendations. No incentive for the spouse to kill them in their sleep.
Man, I watched that show, American Greed. I watched it like years and years ago, like when I used to travel a lot for work and you were just in a hotel and bored. I'd always just like flip on CNBC American Greed. Man, people are killing people for like $5,000. It's you think like it would have to be multiple millions to kill somebody. Man, people will kill you for like, according to American Greed. I remember this one episode where these two ladies, like, they took out life insurance on a guy and then went and killed him. And it was not a lot of money. I don't remember how much it was, but it was like 50,000. I mean, it was like an AARP life insurance policy. It wasn't enough to justify murder. Not that there is a dollar amount to justify murder, but at a certain point, you understand why people do it. Yeah. I didn't understand for 25,000. It's a lot.
Yeah. Where is that field goal post that justifies murdering someone for a death benefit?
What's that?
I was just saying, where is that field goal post in our analogy that justifies murdering somebody for a death benefit?
We should flip around this podcast, and this should be the beginning of it. It'll suck people in. Welcome to the Mind of a Millionaire podcast, where we discuss the habits, routines, and choices that lead to financial independence. Today, we are talking about insurance and how it is a crucial component of your financial plan. And to tell you a little bit about Denver Wealth Management, we do sell insurance. We are independent insurance agents, which means if you get a life insurance quote from us, we go get quotes from 5, 10, I don't even know the number that runs in our little back system to get you the best price. So we are independent insurance agents. We don't have Denver Wealth Management insurance. We don't have LPL life insurance. We just shop the top carriers to get you the best price. And on today's agenda, we are going to be talking about primarily life insurance, the different types of insurance, who needs life insurance, how to assess your own needs, and whether or not you should self-insure. So before we get started, Austyn, I see we have some
scheduled banter.
Some pressing issues to discuss.
We do. Big Monday night for the Hit Squad. The Golden D-League co-ed softball team that Zach coached. I mean, second season and you're champions.
Yeah, it was awesome. We're softball co-ed champions, which is, if you see my eyes are a little baggy, it's because our usual 60 minutes of softball turned into almost 3 full hours of softball, followed by a celebration. So it wasn't even that late of a night. It wasn't that late of a night. It was just, it's tiring. I'm used to going to bed with pretty much at the same time my kids do.
And it's a physical sport. Emotionally, physically, spiritually, it's draining.
Yeah. So Austyn's on the team. Edia was on the team, even though she was out in a different league playing a pool tournament. But all in all, a fantastic thing to do. As someone told me once that you need 3 hobbies, one to keep you in shape, one to make you money, and oh shoot, what was the third one? One to keep you in shape, one to make you money. I think the third one was just one that you really enjoy. Just one that you enjoy and consumes a lot of time. So softball for me doesn't make me money, but it does give me something I enjoy tremendously. And I don't know if it keeps you in shape, but there is a minimum level of like fitness required. But I would say softball falls under the category of something I just really, really enjoy spending time on.
I mean, who knows what's next? I mean, you're champions now. Who's not to say that in a couple of years you'll be making money from the softball team? Ad space on those jerseys.
You know, Rockies need help every year.
Yeah, I'll keep my opinions to myself. Otherwise, we'll get a little carried away.
I didn't say playing. I coach it. All right. So, insurance.
Yes.
When it comes to, so we know health insurance. We're not going to talk about health insurance today. We're going to talk about life insurance. And really, when it comes to life insurance, you have one very big decision to make at the beginning, which is, do you want term insurance or permanent insurance? Now, term insurance is pretty simple. It gives you life insurance for a specified term. So you can pick 5 years, 10 years, 20 years, 30 years. It's pretty common that when you're young and you're just getting started out in life, you have a lot of liabilities. And when I say liabilities, I don't mean just like debt, like the mortgage on the house. You have the liability of like your children, not just your children's college education, but like raising your kids. Raising your kids is going to cost you a lot of money. Paying your mortgage is going to cost you a lot of money. So what you can do is you can buy insurance so that if you were to pass away, you can basically pay for those expenses. So that's life insurance. And term life insurance, you pick the term. And generally speaking, you want more insurance the bigger the liability. So if you have let's say a $500,000 mortgage, not a bad idea to get a $500,000 term, because then if you pass away, the mortgage can be completely paid off. Usually term insurance, there is a fixed rate. So like if year one, so Austyn, how old are you? 26?
25.
25. Okay. So like a 25-year-old, let's say he bought a house for $500,000 with a 30-year term. Typically, for a person like that, the price is usually going to be like $10 to $20 a month. It's very inexpensive. But for $20, if he pays $20 a month for his first year, so $240 a year, that cost will continue for all 30 years. So when Austyn is 55, he will still be paying $240 a year. That's called a level term. You can also get term insurance that increases every year. So you're paying $20 a month when you're 25, but then $22 when you're 26. And why would you get that? Some people ask. Well, the reason is, we don't usually recommend those, but the reason some people get them is that you can, most people cancel their term. So like you get a lower premium the first year. So if you're paying $20 a year or $20 a month for 30 years, they're taking some of that cost out from when you're 55 and plugging it when you're 25. If you get a term policy that increases, you might be starting at say $15 a year, and then it goes to 16, 17, 18, 19, 20. Generally speaking, though, we just recommend level term insurance policies. Now, when it comes to permanent, permanent's like annuities. We always say that permanent is never bought, it's always sold, meaning that you almost have to have an insurance agent explaining all the details to you to try and convince you that it's a good deal. The problem with permanent insurance, let me give you the definition of it before I say all the reasons that you should not buy it. And it also, I should say, for 99% of the people, there's definitely like 1% of the time where permanent can make sense. So permanent insurance never expires. So a term policy, like to use Austyn again as our example, if he lives till he buys his his term insurance when he's 25 and he lives 30 happy years, when he turns 55, his insurance goes away. So let's say he has cancer. Let's say he has some medical condition that means he cannot get insurance. He cannot get insurance at 55. He's no longer qualified for insurance. So that inspires some people to say, well, I want to get a permanent policy. A permanent policy means that no matter what happens between now and age 100, you will always have life insurance. So the way permanent works, if you look inside a permanent life insurance policy, when Austyn is 25, he's really paying a very small amount for insurance. He's paying like $20 a month for the insurance. And then as he gets older, that goes up every month. This is kind of a complicated one to explain, but I'm going to do my best to do it completely verbally here. So if Austyn were to buy a $500,000 whole life policy or variable universal life policy, any of the different insurance policies, even though the cost of insurance would only be $25 a month, they would have him pay a premium of like $200 to $300 a month. And let's use that 200 number. 25 would still go to the cost of insurance. 25 would be what they call a premium charge, which is basically just like an expense to have the policy. And $150 would go into a savings account inside the policy. So Austyn puts away $200. Effectively, 50 goes to the cost of insurance and 150 goes into a savings bucket. Now, if you think about this like long term, and I actually have a horror story of permanent insurance that happens to people. Okay, so the idea has specifically happened to a client of mine. So every year, the cost of Austyn's insurance goes up. It goes from 20 to 25 to 30 to 35. Let's say he does not pass away, and now he's 90 years old. What do you think it costs, Austyn, to insure a 90-year-old for $500,000 for 1 year?
I mean, I have to imagine it's pretty expensive, but you also make it sound like a bummer that I'm still alive at 90 in your hypothetical horror story.
No, the horror story is not that you're alive. The horror story is that for an insurance policy like that, the premium is going to be somewhere between $25,000 and $50,000 for the year. And what a whole life insurance agent, and just so you guys know, we're technically licensed to sell this stuff, but I feel like being licensed and understanding how these policies works means that you almost will never sell them. Once again, there are situations where you might sell them or someone might want them, but the situation that we're talking about with Austyn is what comes up when you don't pass away when you're 50, 60, 70, 80 years old. So Austyn, actually, there's the client that I have that this happened to. He had $1 million whole life policy. I did not sell it to him. He bought it like 50 years ago. And when someone sells you these policies, they say, well, the reason we're saving up that $150 a month in cash value is so as you age, that bucket is rising in value, the bucket of cash. But what ends up happening is every year your cost of insurance goes up and eats into that bucket. So for most people, by the time they're 80, that bucket has been depleted, and now they have to start paying that huge insurance premium out of pocket, which most people do, right? Because they think, well, shoot, I'm 80 years old. I could die any day. I've been paying into this policy since I'm 25. I'm just going to pay that insurance out of pocket. So now you're 80 years old and you have this huge additional expense. So you do that from 80 to 90, but now when you're 90, the premium is insane. It's like $25,000 to $50,000 for the year. And you're starting to wonder, well, maybe I should just cancel this policy. And you've basically spent 65 years paying into a policy that won't pay off. That's not just the worst case scenario. I mean, that's like the logical conclusion of these policies. If you don't die prematurely, they almost never work out. So with that being the case, it makes it almost like if you're going to die when you're 30, 40, 50, 60, 70, you want term. And if you're not going to die by age 30, 40, 50, 60, 70, you also do not want permanent insurance because you can't afford it if you don't die. So it's kind of like this double-edged sword that makes it so you don't want permanent insurance. The only time, the number one time people get permanent insurance is if they have like a very large estate planning need, and their only goal, like let's say your only goal, Austyn, is to leave $1 million to your dog. That's the only thing you care about. You don't care if that million costs you $2 million in premiums over the life of your policy. You want to leave $1 million to your dog. And that's the only thing that matters to you. You don't care about rate of return. You don't care about, I'm trying to use my fingers, rate of return. You don't care about like efficiency of money. So that's why we don't typically recommend permanent insurance for just like someone with, getting started in life and trying to invest their money. What you'd really want is if you had $200 a month to invest or to spend on free cash flow, you'd want a term policy that costs you $25 a month. And then you'd want to put the remaining $175 into an investment account. And you'll be much better off almost 100% of the time than buying or putting $200 into a whole life policy. The other thing they say about whole life or permanent insurance is that you can borrow the cash value. Every time we've tried to do that with clients, when like people will come to us with cash value life insurance policies and they'll say, well, the guy who sold it to me said that I could borrow the money back. When you borrow the money out of those policies, you have to make payments on them, and there's interest payments, and it's a really cumbersome way to get to money. It's super ugly. And since you've taken money out of the policy, you don't have the cash value in there to pay the premiums. So instead of just saying don't buy permanent insurance, I thought it'd be worth it to spend a minute explaining why you don't want permanent insurance. And you want someone to take a look at it. Should you cash it out? Should you keep paying? There are times when you've had it long enough and you have enough cash value that you do want to keep paying. I mean, that is a plausible strategy if you've sunk a lot of money into one of these. The other thing you can do is if you have sunk, like let's say you have a whole life policy that is $50,000 in cash value, and you're going to start tipping over to where you have to pay these huge premiums. one thing you can do is you can buy a paid up insurance policy. So you take your $50,000, you ask the insurance company, hey, how much can I get if I just give you all this $50,000 and I never have to pay you $1 in premium again? How much insurance could I get? And, depending on your age, they might say, hey, I can guarantee you 200,000. Well, that might be worth it for you on like where you are in your stage of life. If you're 60 years old and you have 50,000 in whole life, maybe you just want to go buy a paid up insurance policy and be done with it. But that's something, there's tax consequences for that. So something worth talking to a financial advisor about. And then as far as insurance, who needs insurance or who needs life insurance? Basically anybody who relies on you financially. So if you're the breadwinner in your family, and you have a stay-at-home spouse, well, that person relies on you financially. If you have kids, that person relies on you financially. If you own a business and you have employees and you're they call the key man in the business, your employees rely on you. So those are all different reasons you need insurance. If you're young and single and no one relies on you financially, I don't typically recommend insurance. Some people will want it because they'll say like, hey, what if I get some sort of life-threatening disease that precludes me from getting insurance? That is a risk. It's one you should take seriously, especially if you have like a history of some sort of medical issue in your family. But most like employer life insurance is guaranteed that even if you have like cancer or some life-threatening disease, you can still get insurance through your employer.
And just to clarify real quick, Zach, when you say these folks, these are the types of folks who might need insurance, people with dependents, you're talking about term insurance, correct?
Well, I'm talking just you need insurance. I would highly recommend like I said, 99% of situations you do term insurance, but there's a lot of permanent life insurance in the world. People like the idea of it never going away. I'm trying to pop that balloon that you think it never goes away, but for a lot of people, it does when they expected it to be around in their 90s and their late 80s, early 90s.
And so maybe this is a good segue then to self-insurance. You want to talk about that for a minute, just that process of going from, I guess that you refer to it as renting insurance when you talk about a term policy. So what's that transition look like from going from a term policy to self-insurance, essentially being able to pay those medical bills by yourself?
Well, medical bills would be for health insurance, but for life. So the way I think about self-insurance,
debts, I guess, debts and expenses.
Yeah. Debts and expenses. If you use our strategy here, like we'll once again use Austyn. He's 25. He buys a 30-year term, so he's covered out till 55. If you're on the strategy that we're talking about, by 55, you should have your mortgage paid off or at least close to paid off. You should have a substantial amount of retirement savings. You should have a substantial amount of non-retirement savings. In most situations, your kids are now out of the house and they're maybe on their way to college. You might have money saved up for college. You might not have gotten there, depending on where you started the process. But at that point, the people who are depending on you economically are not your kids. Your house is almost paid off. If you have a spouse who doesn't work, they still depend on you. But it's entirely possible that you have enough money saved up and invested that they don't need some big life insurance policy. In the event that you do pass away at, say, 55 and the life insurance has expired at that point. So, yeah, if you get on the plan, you can self-insure at 55. So, and if you're 35, well, maybe you're self-insured at 65. It's custom for everybody, which is probably the main takeaway from a lot of these episodes is that like everyone needs their own personalized advice because someone without kids is different than someone with kids, and someone with medical, past medical issues is different than someone without past medical issues. All those things factor into the decision. But at some point, Austyn, if you can pass away and your spouse and kids are all fine economically, you don't need life insurance. You might choose to have life insurance just because it makes your spouse feel better. It makes you feel better. But at some point you have enough money in the bank. You don't need life insurance anymore.
Yeah, that's great. I mean, one other question that I have, you keep using 30 years as an example, but for folks listening who might not be ready for that personal one-on-one advice, what do you recommend for assessing your insurance needs? What does that time frame look like for you? And we kind of touched on it, but how much is an appropriate or suitable amount of insurance?
Yeah, we use a field goal analogy for that. On one side of the field goal, go back. There we go. On one side of the field goal is what we call the life insurance minimum. Like, what's the minimum you need for your family? And that would be what we typically say: 1 year of income, all the debt the family has. So like your mortgage, car loans, student loans, credit cards, and 1 year of income. This is the minimum because if the breadwinner spouse passes away, it allows the typically, well, it's not always a stay-at-home spouse, but sometimes there's like the high earner spouse and then the spouse who makes less income and handles a lot of the kids and home life sort of thing. But basically in that situation, you want to be able to pay off all your debt and you want to get a year to figure things out so that you can go, find gainful employment. If you're going to move, downsize houses, if you're going to move, back to Kansas to live closer to your parents, you've got a year, you've got time to figure this stuff out. So we consider that like the minimum amount. The maximum amount is what we call your human life value. And that's what you're worth economically to your family. Now, if you really want to figure out the details of your human life value, you take your income, you take your 401k match, you take your insurance benefits, and you inflate that out from now until the end of your career. So if you're 25, Austyn, and you're going to work for 30 more years and you're going to, continue to progress in your career, you're going to make more money. That's a big number. Dave Ramsey likes to use that 10 times your income. 10 times your income is probably like somewhere in the middle of those field goal posts. The maximum amount, and when I say maximum, I mean, at what point are you spending too much money on life insurance that would be better off used somewhere else? That maximum amount, it's very subjective, because if you're at the zenith of your earnings career, it might be 10 times your income. If you're at the beginning of your earnings career, it might be 20 times your income. So it's a custom number, but basically it's what you're worth economically to your family. As long as you're between those 2 points from a financial advisor perspective, I'm happy with that dollar amount, because ultimately it's the spouse of the insured who needs to be okay with that dollar amount.
Yeah. Too much insurance and you're sleeping with one eye open. It's how you end up on 60 Minutes or Murder Mystery.
60 Minutes. My mom always used to watch like 60 Minutes and Dateline, and I didn't realize until I was older that all those shows are about murder. I mean, it's the same as the murder podcast it's typically young female audience. I look at the podcast demographics because we're podcasters. If you want that young female, like 24 to 35-year-old demographic, man, we should just do murder mysteries. Austyn, we should do murder mysteries. We should do a murder mystery themed life insurance podcast to try and scrape up some of that market.
We could do that. I mean, just think about, I don't think 60 Minutes would be around if people just got appropriate insurance recommendations. No incentive for the spouse to kill them in their sleep.
Man, I watched that show, American Greed. I watched it like years and years ago, like when I used to travel a lot for work and you were just in a hotel and bored. I'd always just like flip on CNBC American Greed. Man, people are killing people for like $5,000. It's you think like it would have to be multiple millions to kill somebody. Man, people will kill you for like, according to American Greed. I remember this one episode where these two ladies, like, they took out life insurance on a guy and then went and killed him. And it was not a lot of money. I don't remember how much it was, but it was like 50,000. I mean, it was like an AARP life insurance policy. It wasn't enough to justify murder. Not that there is a dollar amount to justify murder, but at a certain point, you understand why people do it. Yeah, I didn't understand for 25,000. It's a lot.
Yeah, where is that field goal post that justifies murdering someone for a death benefit?
What's that?
I was just saying, where is that field goal post in our analogy that justifies murdering somebody for a death benefit?
We should flip around this podcast, and this should be the beginning of it. It'll suck people in. But I always look at people who go through all this crazy amount of work on these schemes. Like I watched one where this was on Netflix, not American Greed, but they started stealing barrels of Pappy Van Winkle whiskey, and they turned it into such an enterprise that the whole time I was thinking, if these guys took that amount of energy and started a legitimate business, because they were all smart, they would have been successful and not had to go to jail. like a lot of these criminals, they've got the right like enthusiasm for their work. They just got their moral compass backwards. You just stop ripping people off and you put in that level of energy, you're going to have a successful business. So
I like that. The right enthusiasm for work. If you do what you love, you won't work a day in your life. If that's
right.
Smuggling bottles of Pappy, then
barrels of Pappy. So
you can't even get a bottle. Where do you get a barrel of Pappy?
Well, they worked there, or one guy worked there, and they'd roll up their delivery trucks and roll them into the delivery truck and go sell. I mean, a bottle of Pappy is what, $1,000, and they were selling these barrels of Pappy for like $5,000, and that's like a very substantial discount to the. I mean, they should have been selling the barrels for $50,000. But see, that's the same thing. If you approach that with some moral compass, and you've already got the entrepreneurial spirit. You know how some people go into prison and like teach the Bible. Someday maybe I'll go to prison and teach the young hustlers how to take their hustling skills into a positive entrepreneurial direction. Like, hey man, if you had all the enthusiasm to hustle on the streets, just go hustle like heavy machinery, and you'll be fantastically wealthy.
That sounds like a good course. All right, well, let's
question of the day. We forgot
wrap it up. Question of the day. How can I best prepare for an insurance medical exam?
Yeah, the first thing I'll talk about is like nicotine and marijuana. So a lot of people try and stop smoking the week before the exam, or they stop. A lot of places now, actually, if you're a pot smoker, some insurance companies view pot the same as nicotine, and some of them view it as like the federally illegal substance that it currently is, despite what your state may say about it. So the first thing I would do is ask your life insurance agent. If you smoke cigarettes or marijuana, ask your insurance agent, hey, which company looks at this most favorably? So don't try and lie. Don't try and sneak. If you smoke, just admit it. Pay the cost of insurance, which will be more. Generally on the day before, you want to do everything that brings your blood pressure down. Once again, I'm not a big fan of like misrepresenting like the lifestyle you lead, but if you want to maximize your chance of getting the best rating on insurance, drink lots of water, limit your salt intake, eat low glycemic index type of food that isn't going to spike up your blood pressure. So limit your alcohol for sure. When they do your blood test, you don't want to be, a quarter whiskey in that blood. Get a good night's sleep. They check your heart rate. So I'm the kind of person that as soon as you like check my heart rate, it goes up 50 beats per minute, just because I have that like medical anxiety. So you're supposed to avoid caffeinated drinks, avoid strenuous exercise, drink plenty of water, just go into your medical exam blissed out from a day of relaxation. So, I mean, it's really that simple. Get a good night's sleep. Don't do anything you wouldn't, I would say don't do anything you wouldn't regularly do. Like don't go for a jog right before your medical exam, if that's not something you do regularly. But other than that, be yourself, get the best price you can.
Sweet. Easy enough.
All right, guys.
And if folks need an insurance quote, Zach, where can they find us?
Super easy. You can call us with your telephone, or you can go to denverwealthmanagement.com and email us. You can find us on Twitter, but that's not where you go for life insurance. But yeah, just all we need is like your age. And we need to guess at your medical status, and then we can run you a quote from all these different carriers. We submit your application, just one click of the button, takes 5 minutes. You do a telephone interview. In the past, literally everyone who got life insurance would have to get, they draw your blood. They come to your house, right? They draw your blood, make you pee in a cup. They take your heart rate. Now you probably see these ads on Facebook. It'll say like, hey, if you can run a 6-minute mile, you qualify for this great insurance. A lot of insurance companies now don't do those physical tests because they're expensive. They slow down the process. So these companies like one of the downsides of Google and Apple and Facebook aggregating all your data is that they know everything about you. But one of the plus sides of these companies knowing everything about you is they know, like, if you run or if you watch what you eat. So like anecdotally, the last few insurance policies I have gotten, I did not have to do a medical exam. And a lot of our clients now don't have to do medical exams as well. So it might just be that phone interview and then you're done. If you have a very big insurance policy or you have medical history, they might do the blood test and the P test and come to your house. So yeah, call us up, denverwealthmanagement.com or 303-261-8015, and we will get you quotes toot sweet.
Sweet.